Hey guys, RC Peck here. I don't want to record these and write these and have themes where they are necessarily like end of the hour, end of the day market recap. There's a lot of services, there's a lot of sites, there's a lot of YouTube channels, there's a lot of blogs, vlogs, Instagrams that are like, what happened this hour? What happened today? And I don't actually find them useful for myself because one day doesn't really mean that much. Even if it's a big day with some big announcement, it's the bigger picture that matters most. And it's very clear that we are being driven to think in shorter and shorter and shorter time periods. So this is not a what happened to the market today YouTube channel or vlog or opinion. I look at current information, but I want to do it in the context of what's the big theme, right? What should we what's the meta, what's the macro point of view, or that big kind of first principle that I keep coming back to. And so I want to start today with this price chart today. This week is the chart you see on the screen here, and it's four different types of assets. Now there are only four assets on the planet. I'm not necessarily showing all of them. I split fixed income uh, in half between bonds and not even currencies, but US dollars. And so let me just first describe to you what I'm looking at on the screen. There are four price charts. And at the very top, it's the US stock market with dividends reinvested. And then right below it, it's the US bond market with dividends reinvested. And then right below that is literally just the US dollar index. So that's the actual index. It's not a tracking ETF or anything, it's the actual index of the US dollar. And then at the bottom, that's the actual price of gold. That's again not a tracking ETF or ETN or mutual fund or anything, but the actual futures price of gold. And the big, tall, vertical red line, that's where the US stock market peaked on February 19th. And I want to take a big step back and I want to look at these main assets. Most people get this whole core asset thing confused, and I'm not looking at the biggest assets on the planet. The biggest assets on the planet are stocks, fixed income, commodity, and real estate. Or sometimes I replace real estate with physical assets. So gold is a sub asset. A dollar is a sub asset. Bonds is a sub asset, because between bonds and dollars, the real asset in there is called fixed income. But let's just take a second, more than a second. We're going to take a few minutes and step back and kind of see what's going on here, because we are being driven to think in shorter and shorter and shorter and shorter time period, and it's hurting our wealth. So US stock market basically fell 35%, right? And then from there it's up 43%. Pretty amazing. What I want to know is, what did the other major assets do? So right when on February 19th, what happened to bonds since then, right? Because we now have ourselves 3, almost 4 months post that peak. And the first thing I noticed with bonds is bonds are higher. Bonds are higher from that peak. Now, this is a total bond market index fund, but still bonds are up 2.6%. So bonds have stabilized. They have not fallen. They stopped going up, even though the stock market's gone up incredibly. But bonds have held. They have not continued higher. They have held. And from where the stock market peak, bonds are up about 2.5%. I'm going to round here. Then I go down to dollars down here. Now, dollars are interesting, and I think they're actually the most interesting story to what's going on. So historically, when people get really, really concerned, they put their money in US dollars. They don't put it in bonds. They don't put it in inflation protected treasuries. They don't put it in gold. When people get really scared, it goes to their local currency. And the US dollar is the largest fiat currency on the planet. So this can really help us understand how scared people are. And you can see that the amount of money that went into US dollars absolutely accelerated, but it took some time. It took about a month before money really poured into the US dollar. And it only went into it for a little bit. So it bottomed on March 9th. Okay. and it peaked on March 19th. So about 10 days, money absolutely flooded into the US dollar. You can see that right here. And then it came down, and then it went sideways for a while, and now it's breaking down, right? So the air quote safe haven recipient, that thing is now breaking down. Now, look, I want to talk. I'm talking to you about this with the pure understanding that the Fed has increased their balance sheet. I'm rounding here, but the fact that I can round and say about $4 trillion is pretty impressive. But if you look at the US dollar and you think about where it is today, the US dollar is at the same price it was about, I'm going to just look here, 22 months ago. So the US dollar really hasn't done anything in 22 months. And let me just kind of round that and say in 2 years. Hasn't done that much. Clearly, it's spiked. Okay. But now money is moving out of the dollar and it's moving into other things. And I don't see it moving into bonds because bonds have just kind of stabilized. Again, I know I'm zoomed out on these, but you can also hear what I'm saying. Now, the price of stocks is going up. And what's crazy about this is good news for the stock market. Neutral news is neutral news for the stock market. And bad news is good news for the stock market. So for a moment, set aside whether that should be or should not be. That's what's happening when good, neutral, and bad news is all seen as good news. That means the market absolutely wants to go higher. Now, what's interesting is what the S&P is going to do when it gets back up to its February 19th high. Now, we get to we get to find that out possibly very soon because it's only about 4% away. Now, this is not the index itself. This is a tracking symbol that also includes dividends. But we're about 4% away from finding out what happens when the S&P gets back to challenge new lifetime highs. Gold's interesting because gold was going up before the market did its 35% fall. By the way, so was bonds and so was dollars a little bit. But gold has been going up and bonds have been going up. Now, the difference between gold and bonds is if you look here, gold is still in kind of a holding pattern, just like bonds is. So neither of them have necessarily broken down. Again, I'm using BND for US bonds. And for gold down here, I'm using the actual, just the gold index. So gold has stayed above its new, let's call it 7-year highs, 7.5-year highs. So it's still above that in its holding. The question on my mind is, what does gold do when the S&P or if the S&P breaks to new lifetime highs? Now, it doesn't mean it's going to fall, right? Because you had new lifetime highs starting in August of 2019, and gold was not breaking to new lifetime highs, but it was moving higher, right? So when the S&P, let's see, it broke to new highs, call it April 4th, 2019, and up into the market correction of February this year, gold was up 26%. And during the exact same time period after the S&P broke to new lifetime highs, the S&P went up, what's that? Let's round it up to 19%. So you can have the US stock market breaking to new lifetime highs and going higher. Case in point, went up 19%. And during that same time period, gold went up 25%. Now, I bring this up because gold got hit very, very, very badly. I know, RC, too many varies, in 2013 when the US stock market broke to new lifetime highs. And so it'll be interesting to see what happens if, in fact, stocks do break out to new lifetime highs. Now, look, the NASDAQ 100 is already breaking out to new lifetime highs. There's some other sectors that are biotech, which is a subsector, is breaking out to new lifetime highs. The internet sector is breaking out to new lifetime highs. So those are subsectors. But the NASDAQ 100 is the 100 largest companies in the NASDAQ composite, and those are at new lifetime highs. And I'm looking at that from a QQQ, which includes dividend. So the market is definitely in strong hands. The bond market is being cautious. It's not breaking down. Now, certain parts of the bond market are breaking down, but I'm looking at the total bond market. The dollar is breaking down, which conventional wisdom would say if the dollar is breaking down, that should help gold. And so far, it hasn't. But I want you to remember there's very few has tos, like the gold has to go up if the dollar goes down, right? That's not true. And if anything is true in 2020 is that anything can happen. Oil can sell for negative $38 a barrel. Half the world's bonds can be in a negative yield. Um, and when I say half, I'm really talking more about sovereign bonds. I looked at a chart of Swiss bonds, and you may or may not know, but you can buy a 50-year Swiss bond and you will get a negative yield on that. So every year for the next half century, you'll get a little less back from the Swiss government. So clearly, people are scared and worried. But look, rates have been coming down for a few hundred years, and they've definitely been coming down for 38 years. And so it's interesting to watch. Is this part of a phenomenon of as countries get richer, people save more, right? Because the people who are richer are the older people. And where do they put their money? They put their money in cash and bonds and cash like and bond like equivalents. So, price goes up in bonds, that means yield goes down. It's going to be super interesting to see if yields stay positive in the US because most major countries around the world, they have not stayed. Let me say one thing about bonds, which I wasn't planning on it, but I find it very interesting. I want to show you one bond that has really kind of captured my attention. And let me see if I can quickly pull it out of here because to me, it's really interesting. Actually, let me just show you two. And I've showed you the German 10-year yield before, but this is it right here. Now, it's not that long. We're going back 10 years, longer than most people ever think to go. But I like, looking at 10, 20, 30, 50, maybe even 100 years if I can. But here's the rates on the 10-year, the yield, sorry, on the 10-year, on their 10-year treasury. And look, it's in a clear downtrend. The red horizontal line is the zero yield rate. And so I don't, as of right now, I don't see a scenario where the 10-year German treasury yield gets above zero. That is a decade-long trend. And I'm sure if we had a 38-year chart of this, it would look very similar to US. Now, what I wanted to show you was the Japanese 10-year. I find this interesting. Let me get rid of this thumbnail right here. I like to have the least amount of information on the screen so we can be super clear about this. So this is the yield of the Japanese 10-year. Now, it's positive. Like this is the country that was supposed to collapse John Malden said Japan was going to collapse for, 10 or 20 years. Interesting things about Japan. So I was an Asian studies major and I lived in Japan for a month. And Japan's not the West. Look, there's about 120 million Japanese. There were about 120 million Japanese when I spent a month there almost 30 years ago. So this country is not growing in population. About 97% of all the Japanese people in Japan are Japanese, meaning they're not Japanese American or Japanese Korean or Japanese anything else. They're actually Japanese. So it's a very rich country. They trust their government, and their yield on their 10-year has stabilized. I mean, look at this. This has been 4.5 years of their yield going sideways. This black horizontal line right here is the zero rate, and the Japanese yield is above 4 basis points, guys. I know it's a rounding error, but still it's above and it's not down, and it's stopped trending down, unlike the German 10-year. The German 10-year is still in a downtrend. So the question is, Japan's been in front of the world for a long time with their money printing and buying assets. And their economy is not crushing it by any measurement. And yet, if you go to Japan, you could easily understand and you'd easily very quickly get that it's one of the safest countries on the planet for men or women. So very interesting things that are going on. There was a double bottom. You can see this here in 2016 and then in 2019 that the yield bottomed right around negative 28 basis points. But what I'm most interested in is if the Japanese yield breaks above 10 basis points, which as of right now, I can't imagine it because they got a lot of debt over there. and they don't want to be paying any more than they have to. And if there's any country that controls the yield on the 10-year treasury, it is Japan. So we got interesting things going on, to say the least, for 2020. And look, 2020 is definitely going to go down as, a 1968, a 1929, a 1933, a 1987, a 2000, a 2007. I mean, it's it's not even half over. Um, I want to share one more thing with you about what's going on with the stock market. So if you look at the screen here, this is two price charts. One is an inverse ETF on the S&P 500. So that's the top chart. And the bottom chart is just the S&P 500 with dividends reinvested. If you look at this, it kind of looks like a mirror image. Now, what I want to show you is back in 2018 when the market peaked, call it October 1st, and it fell almost 20%. The inverse went up, right? And I just, for curiosity, what did inverse go up? Inverse went up 23%. Okay, which is impressive because the market itself did not fall 23%. It fell about 19%. So the inverse ETF accelerated about 10, 20% stronger than it, quote, should have. But that's not what I want to show you. So eventually in 2018, the market broke to new highs. Eventually the 2018 fall, it broke out to new highs in April of 2019. What I want to show you is the inverse continued accelerating down. Like it continued lowering in price, right? Which makes sense. But it took a while for the S&P. The S&P kind of went back and forth, right? And so what I want to point out to you is sometimes looking at an inverse fund, you can see if the trend of the thing it's following is accelerating or decelerating. And that brings me to, there's a new low in SH. And the new low happened on May 28th. Now, I bring this up because the S&P itself is not at new highs. And so it tells us about the strength of this acceleration. It being this inverse fund tells us that the strength of this acceleration that's happening is very strong. And this inverse fund has broken down to new lifetime lows, just like it did in April of 2019. Now, there was some correction, so it was not a linear move. And it's very likely if and when the S&P gets back up to its February 19 highs, February 2020 highs, that we're going to want to see, do buyers come in and the price moves higher? Do sellers come in and the price goes down and corrects? Does gold keep stable and go sideways to up? Does bonds break down? And so, as I said at the beginning, I don't want this to be a current affairs, what did the market do today? And I want to have these conversations with you as what are the first principles? What are the things you can do? I'm a big believer in training your brain and rewiring your brain and working on your mindset, because anyone who's ever looked at the market, you can see that the stock market, if you just do a little bit of studying, kind of goes up over time. And the way I've measured it is the market's going higher 78% of the time. So we know the market is on our side 78% of the time, and yet we overcomplicate, we over diversify, we overlook, we overthink, we overdo, we underdo, we do all these extreme things when there's these powerful, simple ways that could actually help us. And so I will take current prices and talk about what I want, more timeless ideas. And that's why I often say to you, like, give me a symbol you want me to look at, because it's not about the symbol. And anyone who's had pick of the month newsletters, they know that I've been given great, you've been given great symbols. You've bought great symbols for years or decades, and it probably hasn't helped you. And so there's got to be something more. If you like this, please like it and subscribe and forward it to a friend or a colleague. And also, too, I have a training called the Diversification Myth training, because what I've noticed the most over 2+ decades of working with people is they're over diversified. And that is a big reason why they don't have the growth they want. They don't have the security, the simplicity, the consistency, the type of control they want back over their money. So if you find some interest in what I talk about here, go ahead at the top of the comments. There's a link to that free training. So I appreciate you guys being in my world. Thank you so much. Again, leave comments. Let me know if there's something you want to have me look at, something that's caught your attention, and I will see if if it falls into what I also talk about. So thanks so much for being in my world. I appreciate it. I appreciate you guys, and I'll talk to you on the next video. Okay, thanks.